Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We'd like to talk to you about your mortgage, what's happening in real estate, and what you can expect this spring buying season as it has just really kicked off, and what we can expect for the summer, the prices, where they're going to go, where is interest rates going to go, and all the things you're going to need necessarily to figure out what you're going to do if you're going to buy and sell this year. There are a lot of different things going on in the marketplace, very interesting. There were a lot of different articles coming out. As everyone knows, I've been predicting a downturn in the economy late for this year, 2019. There are several reasons for that, and in support of that, I have a bunch of information for you today. Main thing is, what happens when the market slows down a little bit in the real estate is that we get sellers and buyers who are a little confused. When it's an up market, i.e. seller's market, sellers dictate price, they dictate terms. They tell you to go jump in a lake if you don't have the amount of money and the loan already in place, meaning that you come with a pre-approved loan and there's no concessions, there's no givebacks. That's kind of how it's been, probably for the last 4 or 5 years. Well, the market has changed, definitely. And it isn't quite a buyer's market, but it's certainly not a seller's market. So there was an article that came out in Mortgage News Daily, and we quote that particular website all the time. It just has a lot of gathered facts from different places in the real estate and mortgage business. So we like to quote that. We like to use that in terms of the information that we have. You can go online and look at it yourself to confirm or look at new information that I'm not giving you on the radio. Anyway, it does talk about the real estate market and what happens. One of the things, there's like 5 or 6 interesting points in the article. I'm bringing up all of them today. Strong sellers market is on the wane. That's the first headline in the particular article that I'm reading right now. So what does that mean? It means that prices, which have been in Southern California, San Bernardino, Riverside, hey to everybody out there in our terrific listening audience, as well as up in Tahoe, California. Hi to everybody up at K-Tahoe, KMET, and KCAA, our affiliates in those 3 areas that bring the show to you. And I really appreciate what they do. It's a great job, and it's kind of a thankless job. I never really mention everybody who does work behind the scenes to bring the show, but I do appreciate it because it allows us on the air each and every week to bring you this information. So, seller's market on the wane. What does it mean? It means that if we historically, the last 3, 4, 5 years, have been looking at 6 to 7% increase in the value of properties, what that had meant, coupled with low interest rates, is that buyers were plentiful. And because of the improving economy through the later stages of the Obama administration, and obviously since the tax cut in the second year of the Trump administration, allowed people to be able to use this money as down payment rather than paying taxes, and also spiked the economy to where we were almost at 4% GDP. We're back now down to 1.8% GDP. We'll probably see close to that for the year as well. But the tax cut spiked the GDP, which led to a lot of new buyers in the marketplace because everybody was fully employed. I mean, we have probably, I don't know how many million jobs. I think last count was about 7 million jobs that had gone unfulfilled because we just don't have the people to fill them. What kind of jobs they are, what kind of pay it is. Yes, this is all in the mix of conversation, but suffice it to say that the economy is doing well in terms of the amount of people employed, and that helped the economy in terms of having people being able to afford housing. So affording housing and being able to get a cheap mortgage, which is what was driving the cost of housing up because more people could afford to buy. Well, it's not that way today. It's in April 2019, and we just don't see the same pressures, even though we have full employment or close to full employment. I think it's 3.8, 3.7% unemployment rate, which if you factor in the expanding employment, we have more people working today than we've ever had working in the U.S. Now, Europe and some other parts of the world which affect the U.S. economy, maybe not so much. But here, yes. And the quality and the amount of pay and the increase in the existing jobs pay, that's all, again, in the relative mix of a conversation of how good is the employment rate. But that's pretty steady. But what we've had is a decrease in the amount of your property being worth, meaning it's not going to go up 6 or 7%, 4 to 6%. It's going to go up maybe 1 to 2% this year. Okay, it's still going up, but what that means is we've got a leveling out of the playing field between a buyer and a seller and a buyer. No longer can the seller take the position. And again, this is new to the marketplace because we've had sellers just, hey, this is my house. I'm going to sell it for this amount. This is what it's worth. And hey, you know what? You don't want to buy it? Then I'll just move on to the next buyer. It's not that way now. Sellers have had to, I guess, readjust how they think. And how they think is, my property's the best property. My property's worth more than any other property on the street. And because of the fact that I live in my property, that makes it even more special and more worth even more. Now, buyers, you're out there, you're thinking about buying a house. Is this a good time to buy? Yes, it is, because you can actually negotiate the price of the house a lot more now than you could 6, 8, 10 months ago, a year ago, 5 years ago, because of the fact that prices have leveled off. Now, why have they leveled off? Because the demand on housing has decreased. Now, it decreased because we had interest rate hikes last year. Yes, that's part of it. Also, we still haven't gotten over the fact that millennials continue to have problems buying houses. Now, why they have problems? I think it's a psychological problem. It also is somewhat of an economic problem because student debt is at historic highs, and a lot of millennials just don't want to take on additional debt, and the down payment in the house is something they cannot get their arms around. In this article, 30% or 32, 34% of the people who were asked said the down payment was the problem. Now, there are ways to get around the down payment, but if you don't want to pay mortgage insurance, then you got an issue with 20% down. Yes, especially with prices at, $500,000 in San Bernardino and Riverside. Let's say you wanted to buy a starter home. Well, you're going to have to come up with at least $350,000. So that, to a lot of people, $350,000, $350,000. Well, you figure it out. 1% is $3,500. And if you want 20% down, well, yeah, that's a lot of money. That's about 60, 70 grand. A lot of people just don't have it. So if you don't want to pay that mortgage insurance premium with an FHA loan or some other such loan whereby you have to come up with insurance, yeah, that's a problem. Okay, let's see. The location. Yeah, location right now for housing that you can't afford, for those people who can't afford, is probably not in the place you want to live. So what happens? You got to live in some place you don't want to live. So then you continue to rent, which means that the demand on housing is less. So therefore, the rise in value in properties is going to be less. And that's part of what this article also talks about. Okay. A lot of times when you're making an offer as a buyer, now I know I've represented buyers mostly my whole career. And what happens? They ask you to lowball. Now, everybody has a different use of that word. Lowball to a seller means anything below asking price. Lowball to a buyer is, 20% below. So anything between 80 and 100% of a asking price, it should be fair game. But to a seller, no. Anything below asking is a lowball offer. So in a market like now, if you're negotiating or want to negotiate and you're a buyer, you do not want to be perceived to be insulting the seller. You need a good agent who's going to go to that other agent and say, hey, you know what? This is what we're thinking about an offer, and get feedback. If the feedback is, oh, forget it, they'll never respond to that, then don't write the offer. But if the feedback is, we're looking at all offers, then that's exactly what they're going to do, receive all offers. So you have to be very, very careful when you're submitting your offer that you don't make the seller angry, right? Interest rate and credit score, the last two things on the list. both of those things are going to be a little bit different. The interest rate is going to be a little less than you think it should be because you thought interest rates went up. And the appraised value of the house is going to come in a little less than you thought it was because the market has changed. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everybody. I'm your host, and I'm Jeff Barton, and welcome to the show. Thanks very much for listening. We try each and every week to bring some great guests to the show, as well as some information that you may or may not have about what goes on in real estate and mortgages all across the U.S., but certainly in some great specific markets that we're currently occupying, one of them being Las Vegas, the other in California. Both of these markets are interesting, and that they're different affords us the ability to be able to help you decide what it is you're going to do this spring. And guests that we bring on to the show in order to help us decide or help you decide is Charles Giscombe, who is the qualified employee and manager of the Nevada branch of Malibu Funding. Charles, how are you?
Great, Jeff. How you doing today?
You know, I'm okay. I'm struggling with what's happening in the marketplace, and I'm not quite sure where to set my right and left foot. Can you square me away there?
Well, obviously there's a little, people are wondering if we're going to get into the end of the Las Vegas bubble here, and are a little bit nervous about moving forward. Not quite sure if the interest rates are going to increase, if we're going to bottom out. I feel like if you play it safe and you play it steady, there's still some room for you to make some money, obviously to pick up some properties, as long as you don't go overboard and bet the house that the equity is going to ride out for you. Not get too greedy. I think that you still have some room in order to get some work done. Obviously, there's some things, and the time keeps shortening because every time we do this, Jeff, we're like, we got 16 months, we got 14 months, we got 12 months, right?
Right.
All the way down to whatever it is. I feel like based upon what's going on with the economy right now, we're still okay. Interest rates are still okay. I mean, obviously, there's going to be some rate increase, but if you play it safe, not get too greedy, like we said, I still think there's a great market out there for investors and home purchasers or borrowers in general.
You know, in Las Vegas, it's interesting. There's a steady stream of a certain type of person that goes to Las Vegas. I don't mean psychologically. I mean searching for work. People that go to Las Vegas either work at the hotels, work in construction, or other such industries in the service-related fields. When we calculate income for particular loans, especially when the prices have really doubled, almost tripled since 2007, 2008, how do we figure on satisfying employment or satisfying the employment needs of the loan for each in particular borrower?
I mean, like you said, if you're working at the casinos, a lot of people working at the casinos, a lot of construction workers, you called it right, because there is that kind of business going on. And obviously, for the casinos in that particular industry, they're not going anywhere, right? So you have those individuals. They make good money, and the pricing for the housing market there is still fairly good. People can still fairly buy. Obviously, they're doubling, and from an investment standpoint, people want to get in. But Jeff, I really feel like, in Las Vegas, unfortunately, there's no middle of the road.
Right.
You're doing decent, or unfortunately, you're not. And as far as qualifying for home loans, we have a number of different loans that we can get people qualified for, Jeff. We always talk about this from a traditional standpoint. We have programs that can offer the individuals with lower FICO scores don't have a lot of money. We have some programs from all the way up to the individuals who are doing very well. And that want to get into these different non-traditional types of loans that they can afford. One thing we always talk about with Vegas is, like you said, those jobs are there, and then there's a segment that's not doing really well. So, but we have a number of different loans that can cover all our bases and all types of individuals that are in Las Vegas. that work from that realm. I hope I answered your question, Jeff.
Well, I think yes. The issue with Las Vegas has always been trying to make sure that people are not as transient as they may seem to appear to a loan. To somebody who has to approve that loan, an underwriter
Right.
is going to look at the longevity of the person and the probability of that person being able to repay the loan. Because as you and I both know, that's at the heart of every loan we give.
Absolutely. That's absolutely right. And as a person transit, the one thing that we do know about Las Vegas is that every day it's growing. And
Right.
with the new athletic teams and the sports teams coming in and the constant building that we talk about, Jeff, obviously there's jobs out there and individuals are here. And like you'll be surprised, the individuals that don't go to the Strip, there's all the surrounding areas that people are living in Las Vegas,
Right.
in Henderson and Summerlin and Southern Highlands, and even further out, there's individuals that are out there. I mean, you don't see that group of people because they really rarely come to the Strip because they may not want to deal with that aspect of it. But there's a lot of individuals that are coming to Vegas. We also have to look at that segment of individuals that are coming from the surrounding areas of Arizona and California, Jeff, that are coming in because the markets in California are so high and the pricing is so high for houses that they'll come to Las Vegas to buy an investment property or a second home. You have to look at those individuals, and those individuals come in all the time, and there's more and more of them coming every day. So you have, like you said, there's some individuals that come to Sin City to have fun and play, but there's a lot of individuals that are coming to stake their claim and plant their roots in Las Vegas because it's less expensive. And despite what other people may think, there is a lot of opportunity that's coming to Las Vegas.
Yeah, you know what? I watched the Golden Knights a couple nights ago win a game, and that particular team has taken, like you said, they've taken root there. They have made Vegas a place where people can be proud of just because they have a sports team. I think the football team will do just as well. I did see some pictures of the stadium. It looks unbelievable. I'm sure it will be a terrific draw. These kind of things give pride to a city, and I think as a result of that, people will be much more willing to look at Vegas as an alternative city to live, as opposed to just, as you said, Sin City, come in, do whatever you got to do, and get out. And I think that's the kind of person that anybody who makes a loan likes to see. But at 2.5 million people, that's a pretty big city.
It's a very big city. It will continue to grow. Those jobs are going to be available. You're going to have concessions. You're going to have more, there's going to be more people coming with the sports teams coming, Jeff. There's going to be so many jobs that are going to be needed to be filled. There's going to be more building that needs to occur,
right.
and it will continue to increase. And you'll see the building in the surrounding areas. The developers and the builders, new houses are going up. We do believe that these jobs will have individuals that will be looking to purchase in this market, and they'll be solid. And you'll have other individuals who are solid coming from other places to possibly getting transferred over. So I have a confidence that, like you said, that the Knights and the Raiders are coming in. And I do believe that behind those kind of teams, I think there's an NBA team on the horizon that people are looking at that may come. There's going to be different opportunities. And who doesn't want to come? What person doesn't want to come? What athletes don't want to come to sunny Las Vegas?
No, I agree with you. I mean, if I watched the Masters golf tournament, right? And outside of Tiger winning, the next particular headline was Vegas loses a ton of dough. So if the major sports news of the year, and right below that is Vegas. So it's on people's mind all the time for whatever reason. It's a destination. Give us the favorite loan product that you have available for people right now.
You know what? We always do traditional loans, Jeff. We're always doing traditional loans. That's FHA loans. We're doing VA loans, government loans. Obviously, we can do conventional loans. I personally have been doing a lot of the non-QM product, which is the non-qualified mortgage product. That product is for individuals who are self-employed, who may write off, a lot of money on their taxes if they're because that's what they're doing. They're in business to keep the money, not give the money all away. But what it does, it allows those individuals who can show consistent deposits, consistent influx of money, the opportunity to use the income that you see in their bank statements as their deposits as their income. How amazing is that? You have a person that has a big business, they're writing everything off, they have so many expenses, so now it looks like they don't make any money, they're in the red. But in all actuality, when you look at 12 months or 24 months of bank statements, you see an individual that is making $25,000, $35,000, $45,000. And how great is that there's a program that would take that $35,000, $45,000 a month into that business account and use that as the individual's income. So now there's no zeroed out tax returns, but now there is $45,000, $35,000, $25,000 a month that can be used as an income. And we know what that does to debt to income ratio or liabilities, as opposed to showing where you make $5,000, now you're showing you make $25,000. Your debt to income ratio becomes great and doesn't become an issue for you to get a loan and get qualified for a loan, which is amazing.
Charles,
great program for those individuals.
Thank you very much for coming on the show. That is a great program. I want people to listen to what Charles said and pick up the phone and give him a call. It's on your screen. Thanks, Chuck, for being on the show.
Jeff, thanks again. I appreciate you.
Anytime, man. Thank you very much. And I'm Jeff Barton, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, and I am your host for the show, and welcome to the show. Thanks for tuning in. Each and every week, we bring you some interesting guests and solutions to problems that you probably don't even know you have. For instance, do I have the down payment? Is that property available? What's the market look like? In Las Vegas, Nevada, we like to go to the experts in the field before anybody else gets to them. One of these terrific experts that we go to each and every week, or almost each and every week, at least we try to, is Janti Chun, who works for Realty One Group. Janti, how are you?
Good, Jeff. How are you doing?
I am okay, thank you. Just struggling to try to figure out what's happening with the market. We have some obviously conflicting reports about what's going on, but it looks like in Vegas, at least employment's going well. I know you too are an employer and own your own business, and I wanted to talk to you a little bit about that.
Yes, you're right, Jeff. I mean, employment is increasing, which is a great thing, you know, for the economy. Mm-hmm. And also, yes, I'm a small business owner. It's been slightly tough for me just because I'm rebranding my business.
Now, first of all, let me tell people, you own a ice cream store, right? An ice cream shop, or however you describe it.
Yes. In addition to a few other business ventures that I'm involved with, the other main one besides real estate is, yes, I have an ice cream. Well, it's a gelato.
Gelato. I apologize. I knew it was something fancy. I just couldn't remember what it was. No, but being a business owner and somebody who has to change a direction in midstream, there isn't a business owner out there who hasn't had to do this at least once during their time of ownership, if not multiple times. How do you do it? What are you doing? And how's it going?
Well, it's going. You know, we've just basically parted from the franchise, which was a good franchise out of Europe, but we discovered that their branding wasn't is very different for the American public, basically, right? So we had to rebrand for the American public and American consumers. And it's been a little challenging just because you have to change everything quickly, signs, and employees aren't happy because they're restless and they're unsettled too because things sometimes don't move as quickly as it should.
Right.
So, but I'm working day and night basically, to try to get the store with the new name, and it's called Mon Amour.
Okay. Once again.
Mm-hmm. It's called Mon Amour, which means my love in French.
Okay, very good. Address, please?
The address is 875 South Grand Central Parkway, and it's in the Premium North Outlet in Las Vegas, and we're on the north side of the mall near Cheesecake Factory. So it's right in the spaghetti bowl of Las Vegas, downtown.
Right. Okay. So you mentioned that the Americans, as if we're all some sort of homogenized conglomerate of people, but I know Las Vegas, as most cities, has very many different nationalities, ethnic groups, people from all over the world get there. So how are you're rebranding, which I like the name. How do you think that's going to appeal more than whatever the name was before? How do you come to that decision? Is it a personal choice, or do you hire people? How do you do that?
Yeah, well, no, I'm actually, my partner's from Paris.
Oh, I see.
Just doing we're doing the rebranding ourselves just because We don't have a lot of money. Obviously, from the franchise that we did have before, we weren't doing very well.
I see.
Because the numbers were low, and our product pricing was very high. Our franchise charged us a lot of money to be part of the franchise.
I see.
Which came from Europe. So
I
now
see.
the American market is, we discovered over the last couple of years of, kind of our business not doing that well. The numbers were decreasing a little bit, especially this past year. Now, it's not just the actual brand, but it also has to do with consumers. And now consumer all across the board has been a little bit low, especially in the retail business.
I see. Yeah, of course.
Yeah. Even in our mall right now, retail shops have closed down. Most of them, everyone's going online.
Well, you can't buy an ice cream cone online. I'm sorry. You have to go to the store.
Exactly. So for us, that's what I was going to say. Now we have I guess our plus is the fact that people have to come in and taste it and try it.
Right.
So now what we're doing is to match better with the American market is we're changing the way our product looks visually.
I see.
Basically to attract more people going, oh wow, because Americans or people that come to America, America is known for everything being really big and colorful, right?
Yep, that's right.
And so that's what we're changing it to. Our branding before was very subtle, very classy, very nice. It was a very good brand from Europe, but it didn't, numbers-wise, it wasn't good with the American market.
Let's switch gears a little bit. Talk to us a little bit about what's happening in the real estate market in Las Vegas, whether prices are stabilized and whether it's becoming more of a buyer's market. What do you think?
Mm-hmm. Well, honestly, Jeff, it's still a seller's market.
Okay.
Because the inventory is so low. I mean, compared to what inventory should be for a stable market. Remember, a stable market is around 6 months, right?
That's right. Yep.
So for the last year, so say March from 2018 to now, 2019,
right?
There has been a slight increase as far as the supply. We're looking at about 3 months supply right now. So it's increased a little bit. And the homes also from last year, this time to now, we've seen an increase of inventories of about 44%, but it's still a seller's market.
Because we don't have an equal number of buyers and sellers, which is the 6-month inventory you were talking about.
Exactly. Yes.
Where are we? What are we, about 3.5 months? Is it less? Is it more?
3. Yeah.
3 months. Is that what you said?
Yeah, actually 3.1. So 3 month supply. So I mean, it's still decent now. Another thing is, even though it's a seller's market,
right?
Sellers are also starting to be a little more realistic now. This time last year, sellers were asking quite a bit, and we were able to sell some, or most of the inventory because of the demand. But now, since you're looking at a 44% increase in inventory, basically from last year, most of these properties are sitting on the market a little bit longer than normal.
Are you finding appraisals having a bit of an issue, i.e., they're not coming in where you think they should, or at least where the seller thinks they should?
Oh, absolutely.
Mm-hmm.
Yes. I mean, not a high percentage of it, but appraisers, I think, are having to go out just slightly over maybe a mile, maybe sometime for certain appraisals to come in. But they're being pretty conservative themselves also.
No, I think so. And I read an article just today about how appraisers are actually trying to come in lower simply because they're afraid that we're overvaluing the real estate just because.
Yes. I like I mentioned many times before, I think we don't want anything to happen even remotely close to what happened a few years back.
Right.
So everyone is conservative to a point, but sellers, with sellers now, even though there's a low supply, prices are kind of high, and some sellers, are kind of stuck on the unrealistic value of their home. But if you, as an agent, show them the numbers in a chart, which are actual facts,
mm-hmm.
then sellers, for the most part, are pretty reasonable, and they would, come down on the price or price it correctly.
Where do you think the best deals are in Las Vegas right now, whether it's condo, townhome, or single family?
Well, as far as median price,
right.
Single family, you're looking at about around $300,000, right, for single family home.
Yeah. Yeah.
Townhouse and condos, median price is about $167. So condo and townhomes are still a little bit more affordable
Right.
than single family.
I hate that HOA, though, don't you? I mean, everybody hates that HOA. Even if it's only $30-$40 a month, nobody wants to pay it.
Yeah, but no, townhomes and condos is always more than $100.
Oh, absolutely right.
Yeah.
And that's $1,200 out of your pocket each and every year. That,
Right.
what do you get for that? And that's how people look at it. And that's why there's always been historically a problem with the HOA getting paid.
Mm-hmm. Absolutely. HOA is going to take their money. So with townhome and condo market, yeah, you have to look at those numbers, basically. But, the rent value, if you're going to buy it as an investment, condos and townhomes are still lower than single family. Single family is still the best investment if you want to do rentals.
Right. New
And,
or existing?
Oh, no, definitely resale.
Right.
Existing. Yeah.
Right.
New homes are, they're still demanding, upwards of $200 per square foot.
Oh, yeah.
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 So they're doing okay, but inventory is low on new homes as well. It takes, still up to about 6 months for building.
Yeah, exactly.
New homes.
Hey, Jean-T, thanks very much for the update from Vegas. Really appreciate you coming on the show once again.
You're so welcome. It's my pleasure, and thank you for having me on the show again, Jeff.
No, and we'll see you soon. I'll be out in Vegas in May.
Yay! Okay.
Excellent. Very much. This is Jean-T Chun. She's from Realty One Group, and I'm Jeff Barton. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Mortgage Industry, 888-713-2929 is our telephone number. Pick up the phone, give us a call, or you know what? Write down the phone number. You probably have questions, but you want to listen to the show, so don't get bothered. Just write the phone number down, 888-713-2929. Think of a question. Call in later. I'll be happy to talk to you anytime about whatever question you have. I mean, this is a changing market here in Southern California. Our great people out in San Bernardino and Riverside know exactly what I'm talking about. Do I rent? Do I buy? Where's the market going? What's the inventory like? All of these things are incredibly important, especially now since we're getting into those months whereby we're going to see more inventory, but we're also going to see more buyers. So what's going to happen to the prices? What's going to happen to the mortgage rates? All these are questions we're going to try to help you answer. And to do that with me today, Michelle Chavez, who has never been on the show, but was kind enough to grant us, her particular expertise on what's happening in the marketplace. She works, of course, for Fairway Independent Mortgage Group as a mortgage loan officer. And Michelle, welcome to the show.
Hi, thank you so much. I'm glad to be here.
Thank you very much as well. Okay. You have a great background, and as I was reading about your insurance background and obviously now being in the mortgage area, risk is always determined by, I guess, who's looking at it, right? I mean, whether it's insurance or whether in mortgage. How do you assess risk, i.e., how do you know when you have a buyer that should go to one program as a loan versus another program for a loan?
So pretty much with determining what loan program our buyer is best suited for, we look at several things. Capital, we like to see that they have, money to go ahead and purchase this home. We want to see their credit history. Some buyers are self-employed, so we want to look to a specific loan program for them. Sometimes they don't show as much income, and so
Right.
maybe an alternative loan as far as not a QM loan, but
Right.
out here in my area, in Marietta Temecula area, we have a lot of VA buyers because
Right.
of the fact that we have Camp Pendleton so close. So a lot of times we are able to put them into a VA loan, which is a great loan, especially if they have any percentage of disability. We're able to waive the funding fee on that. So.
Oh, I didn't know that. That's great. That's really good. So could you say that once again for those that may have not been paying attention?
Yes, if a veteran has 10% or more of disability, they're able to waive the funding fee.
And how much is that funding fee traditionally?
It can be up to thousands, $20,000 or so. It can be, but it depends on the loan amount.
Oh, no, that's really good news. Now, I've been out
and it depends on if they've ever used it before, their award before.
I see. So now you can use, obviously, this to purchase a house. Can you use it for any other purpose, a VA loan?
You can refinance a VA loan as well.
Okay, excellent. How long have you been out there in Temecula? I love that area, by the way. I did a Ragnar race out there a couple of years ago.
Oh, okay. I do Ragnar as well. Did you do the trail? Right?
Yes, that crazy trail run, and I don't know if I'm
do
going to...
that too.
Oh, excellent.
I've done it 4 years in a row, yeah.
Oh, my gosh. We went out there 2-3 years ago, and I had never done a Ragnar. And, of course, we went out there with an 8-person team, and we were all psyched up, ready to go. By the end of it, which, as you know, it takes quite a long, at least a day, if not a little bit more, we were all very excited but very tired.
Exactly, yeah. Those are fun. I've done several. I really like them.
Yeah.
I've been out here in Temecula, Murrieta for 20 years.
Okay, excellent. And obviously, it's a great area. You'll love it. I love the outdoors there, and it's a lot bigger than a lot of people think. I was out there, and I was surprised. I love the town of Temecula. I just thought it was a terrific place. It was a lot more to do there than I ever had imagined. And, of course, being from the coast out where I am, I just never think about other places in California and the beauty that lies there. That's what struck me, how beautiful it was.
It actually, it's very beautiful. We have the desert, and then we also have all the wineries. It's absolutely beautiful. There's some nice hiking trails out here. Yeah, it's really a nice place to live.
So you were talking a little bit about non-QM loans. Explain what a non-QM loan is for the audience who doesn't know.
So the QM loans are the qualified mortgage loans. So those are loans that are insured by Fannie and Freddie.
Right.
So the non-QM loans are loans that are alternative to that, and they are like bank statement loans where we can look into income in a different way than the QM, the qualified mortgages.
I see. So, and in that non-QM and how you look at the income, basically you can take a bank statement or 12 or 24, whatever the program might be, from either their personal or their business, right, in order to qualify for a particular loan in the non-QM field?
Yes, that's correct.
Okay.
It usually requires a little bit more money down, 10% or 20%, depending, but they are really great options for people who are self-employed. Okay,
I think that's really important too, especially now the prices out there, real estate prices, are they as high as I guess they would be in the rest of California? I assume they are.
Well, actually, that's one of the great things about this area is it has stayed very affordable for families. We have large houses out here, but they're very still in price ranges that people can qualify for easily with lower income.
Right.
That's why a lot of people from Orange County, San Diego, and LA actually end up out here because they can get a lot more home for their dollar. The square footage of the homes are a lot larger here, and the prices are still very low. So we're lucky to have that. We're very lucky to have that. I mean, there are expensive homes out here, of course. There are very nice areas that are more expensive, but it is nice that it can stay relatively inexpensive comparatively to other areas in Los Angeles and Orange County, Southern California.
When you look at a customer and they come in the door and they want to sit down and they want to talk to you about a mortgage, what's the first thing you do? Do you take an impression of the person? Do you look at their credit score first? How does your process work?
So I usually sit down with a buyer. If they're a new home buyer, I usually sit and explain the process a little bit to them. They don't always understand, and they're a little bit intimidated sometimes by the process.
Of course.
So I'll usually sit down with them and kind of explain a little bit before we get into the qualifying them. And then as far as qualifying them, I'll sit down and take a little bit of an application, get some information, Social Security, date of birth,
right,
address, that type of thing, so that I can run credit. And then I'll explain to them that we're running credit, and then sometimes people need a little work on their credit, so
right,
I can kind of do a simulation or something to help them so that they can get, sometimes I'll sit down with buyers and they're not necessarily ready right now to purchase, but I can help put them on a path to purchase, even within 3 months, 6 months, a year. So a lot of times that's what I'll do. I'll sit down, and then once I take all the information down and run their credit, we can look at their income documents and kind of tell what purchase price they should be shopping for.
When people walk in the door, whether they're young, old, medium, whatever their age might be, is there a difference in how they trust you as a professional, or do you take the approach that every customer is different, but your ability to, I guess, engender trust with them is really at the heart of what you do.
Absolutely.
Right.
I think that, anybody who's coming in, every walk of life, they're all different, but
Right.
a lot of times some of them have purchased before. I have, lots of people who are investors who come back to me. And I think the biggest thing is that I just look at each one and try to assess the best way that I can help them in their particular situation. And I want to find the best loan program for that particular person.
Yeah.
So for me, I treat each and every client exactly as if they were my son or daughter. So.
Oh, that's good. So you have a couple of kids. Good. I do too. I have 3 kids. That's good.
I have 6.
Oh, well, anybody out there, this person needs some business, so let's help her out. I'm just kidding. I have no idea, but 6 children. Well, good for you.
So so when the clients come in, I think I'm used to being patient and
Yes, you would. Yes, you would have to be patient with that many children. With 3, I had to be patient. Even still, even though they're fully grown now, I'm still patient with them.
Yeah, mine are grown as well. My youngest is 18. So.
Okay, mine is 19. So, we're very similar in that way. Well, you know what, Michelle? Thank you very much for coming on the show. I do appreciate it. Want to have you back again for a little update about what's going on down in your area. Thanks again.
Fantastic. Thanks for having me.
Thank you very much. And this is Michelle Chavez from Fairway Independent Mortgage Corporation. Michelle, shout out your phone number one time for us so people who want to call you in their car right now can.
Fantastic. It's area code 951-691-6187.
Thank you very much. Appreciate you coming on the show.
Thank you. Have a great day.
And you too. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. You can pick up the phone and give us a call. That would be great. We'd like to talk to you about what you're doing this spring and summer. If you want to move, if you want to sell, if you want to buy, if you want to do things in the real estate market that you just need some either confidence, maybe you're trying to find that perfect mortgage. Now, there are a lot of mortgage programs. We've had guests on the show today talking about the different types of programs. Did you know that the non-QM mortgage is accounting for 30% of the mortgage marketplace? That's about $500 billion in loans this year of a $1.7 trillion loan business, which we'll probably have this year. You think about that. 4 or 5 years ago, we were 100%, or at least 90%, government GSEs, meaning Fannie Mae, Freddie Mac, or FHA. Not that long ago. 5 years later, third of the market is independent from all those 3 government-backed sponsors. Now, what does this mean? It means that there's a cushion, a protection, a something between them and us, meaning that the private sector, whether it's insurance companies, Wall Street. Now, we say Wall Street. What does that really mean? Well, there's a lot of people on Wall Street who make a ton of dough. And there's people with that dough who open these hedge funds or open up investment vehicle funds or open up abilities by which you can invest in REITs. All of this has to do with money made on Wall Street, right? Even Wall Street houses have lots of money so that they are able to guarantee income if they get into certain loans. So 30% of these loans, i.e. 30% down loans, 20% down loans, 25% down loans, are a pretty good risk in a market that keeps ascending. Now, we're not going to ascend this year the way we did in the last few years, i.e. 6%. But let's say we even go up 1%, 1.5%, 2%, which is probably closer to where it's going to be in a lot of the markets in the country. Even at that, if you can guarantee through what you're purchasing from the non-QM sector as a particular large investment house, bundling product together in order to sell bonds off at 3 to 5%, well, that's pretty good because most of these loans in the non-QM space are going to be at least 3/4 to 1.5 points higher than a QM loan. So if you currently have 30-year fixed rates, and let's talk rates for a second, 30-year fixed rates are about 4% right now. Okay, 4%. So if you're 1.5 points higher than that at 5.5%, you can keep the 1.5% in-house for yourself and sell bonds at 4%. Well, treasuries are at 3%. So if you can get a mortgage-backed security and you can buy that bond, and they're all insured, whether it's the dreaded credit default swaps or some other type of insurance, whether you hedge or whether you actually go long, and all these are funny terms if you don't know what they are, but it's a pretty good deal if you're in that space. And as I said, with 25% down with most of this product, those are pretty safe loans. Who's going to go bye-bye or not pay on a 25% equity into a loan? Everybody's going to continue to pay. Why? Because you don't want to lose the equity in the property. Now, let's say we have the worst-case scenario whereby we have a recession and property values dip by 30%, which in some parts of the country, that's exactly what happened during the last recession. Some even more, but most were not as high as 30%. Well, it means that you're still at break even because the property is going to be worth exactly what the loan is. Now, this is a pretty safe loan, which is why, in fact, the non-QM space is growing. And most lenders out there in the marketplace are expanding their portfolio of product. Now, interesting article came out, and I've been talking about this too, so this isn't like a news flash, but it's just confirmation of what I'm saying is also being said by people in the industry. Jan Swanson, another person who we quote and use her articles each and every week from Mortgage News Daily. Appreciate it again. Okay, so in this, it talks about non-bank lender, this CEO, and this CEO is from Caliber. Caliber is one of the top 3 non-bank lenders in the U.S. Now, what's a non-bank lender? It means it's not Citi, it's not Chase, it's not Union, it's not, your regular bank at the corner, right? Bank of America, Wells Fargo, it's none of these. It's lenders who do not have retail outlets per se to deposit. They're non-depository lenders, Caliber being one of them. It's the 3rd largest in the country. Well, the guy who is the chairman, a guy named Sanjeev Das, CEO of Caliber Home Loans, says that rising home prices, which have made owning a home less affordable, has also made this difficult for mortgage lenders. Originations have fallen. Okay, what does that mean? So if prices go up, the originator, the person like me, people who work at Malibu Funding, who sponsors the show, thank you very much, they cannot get enough buyers in order to be able to continue to grow their business. So volume in the loan business dies. Well, that's problematic for large banks, right? Large banks have overhead. They have buildings. They have employees. And they're publicly traded companies. So all of these things affect bottom line and share price. So into the mortgage business, they do not want to go. So most of the mortgage business is done by non-depository lenders. But the conundrum, the problem, is that if you have a shrinking marketplace out there, I've talked about this every show for the last 6 weeks. If the marketplace is shrinking, i.e. less loans, you have got to increase productivity when there's less available productivity in the marketplace. There's only 2 ways to do that, and it mentions it in the article. The 2 ways are you lower your margins, i.e. you tighten your belt, like we all do, or you lower your credit standards, i.e. you make the loans easier to pay, easier to get. That's why the non-QM space is growing, because 1, it allows a lender to be able to expand its portfolio of loans to things that you couldn't even think about getting 5 years ago. And that's an important distinction. The other distinction is they're non-government backed. And not being non-government backed loans is important because it means if there is a recession and there's problem with these type of loans, it does not affect Fannie, it does not affect Freddie, it does not affect FHA Ginnie Mae loans, which means that you're not going to have a government bailout of a Wall Street hedge fund. It's just not going to happen. These are risks taken on by the private sector, which means that obviously those loans are going to cost you more, but at least you can get the loans and the originator can stay in business, because without an expansion of their particular portfolio product, there is no way that all of these lenders can stay in business, which, as I said, you're probably getting and as I said in the article, 50% of purchases in this country are done by non-depository lenders. Now, that's a big number. If you're thinking 5.5 million homes will be purchased this year in the U.S., 2.5 to 2,750,000 of those loans are done by non-banks. That's a big number. And 45% are also serviced by non-banks. That's another big number. And these are good things because it removes the government from backing or guaranteeing if the loan goes bad, i.e. Freddie Mac, Fannie Mae, and Ginnie Mae. And those things are very important when we're talking about the overall economy possibly going into a recession late this year, early next year. You know, the benefits of that tax decrease or the tax cut that was passed last year are almost up, right? So people are seeing less in their tax returns this year in terms of what they get back from Uncle Sam than they did last year, and that's a problem. And they're also seeing less the effects of companies being able to save money on that first, because once the company adjusts, takes a year to adjust, they're not going to see the benefits or the expansion either in buying of big ticket items or people getting a raise or stock dividends, things like that just won't happen this year. So a lot of things going on in the marketplace. I think if you're out there right now and you're listening to this and you're going, what the heck is all this talking about? We're talking about choice in the marketplace and the ability of you to get a loan and whether it's going to be easier or harder this summer when you're trying to buy a house that you're not quite sure you can afford. I hope we've answered some of your questions this week. I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you listening to the show each and every week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.